Yeah, so okay, this class was intended or is intended to basically break down the structure and the method behind how I trade. Giving you guys just a quick insight to it, not really a Hail Mary, but breaking down it's everything I do to the best of how I can so as to help you guys understand how to trade in this context, the financial market. So as I said in the call schedule on my Twitter, it's we're going to be focusing on two pairs, which is XAU USD and BTC USD, giving off the analysis and the breakdown from top to bottom on how I look at and view these pairs in order to make the right decisions and analysis. So there are so many complex. There are one or two complex entries that I use to take trades. So I'll be explaining only the easy ones for you guys here, so you guys will easily understand them. So the first one I'll be explaining is what do you call it? It's support and resistance. Support SBR and RBS. Support break resistance. Resistance break support. Whereby price goes like this, comes back in, taps the support, and then goes higher. That's only intended for bullish move, and in the opposite case, bearish move. When price comes from somewhere like this, and back down here. So this entry now, it's these two entries are called SBR and RBS entries. That's what I call them. It's just terminologies. A different traders have different names for different things, so you don't have to worry about that. All the same stuff though. SBR and RBS support break. SBR I'll call that support turns to resistance. Yeah, support break and resistance. I'll explain what that means shortly. Then RBS resistance resistance break support. Let me check if this is recording. Yeah, it's still recording. So basically these two things. Now let me explain them further for you. Let me redraw this bullish one out specifically. Yeah, let's do something like this now. uh This and this. Yeah. So now these are the two models. Basically all still similar. Just need to understand how they work and now basically what I draw out talking about resistance. Resistance is a level on the chart where price tanked, price went below from that level. So that top, the top is called a resistance, while support is an area on the chart where price shot up from, like where price went up from, where price bought from or rallied up from, whatever English you want to use. So basically, price did something like this and eventually came back down here, broke that support level. And as it broke that support level, eventually that support level becomes a resistance level. Whenever price gets back there, you'll have a reaction at least in that level. So you can have it in different ways. This level was a support turned to resistance, SBR. Now this is an RBS, a resistance turned to support, whereby price is bullish and you look to take this as a long to the upside. So now this is a model, and I have to like break down some things to you guys, which is first thing you need to note is that price should, in order for the RBS or SBR to be more, strong and everything, price should have created a break of structure to the opposite side, and which is here. This is a break of structure here. For instance, a break of structure meaning price went above, broke a previous high. BOS, yeah, like that. Come in, let me set that right. Middle center, yeah. So that, and price should also have given a BOS in the opposite direction for the bullish case. So now this explanation on what I'm saying, let me just give it to you like this. Basically, yeah, basically, price does something like this. Price is bullish generally, still going up, and then price comes, takes out a previous low. This was a low here. This point here was a low. Let me get my tool to draw brush. Okay, this here was a low. Where's my tool? This here was a low. Come on, let me admit back. Yeah, so back to what we're saying. Sorry. Yeah, back to what we're saying. This now price did something like this. Open up, close here, and what I was talking about was basically price has to create a break of structure to the downside, thereby forming a resistance level and also a supply level. So SMC traders will call this supply level, not just a resistance level, an area where they're expecting price to crash from. On a regular, in a regular scenario, price should have done something like this. Yeah, price should have done something like this and gone back down. Yeah, but instead, price didn't do that. Price broke through it, and it broke through it not just breaking through it, it broke through it with impulse, went up. Get that? Price went up, broke through it, invalidating it, and now that place that is invalidated will become a support zone. From a resistance zone, it will become a support zone. That's how. So that's the case. Price was meant to react from this supply zone, but instead this happened. It was meant to react from supply zone and go down, make another break of structure, but instead this happened. Price broke it, invalidating that zone and creating an RBS resistance turning to support. So this is this line I drew. Sometimes you can get down here, just now this zone, this entire zone, which was meant to react as an area for resistance before will turn to an area of support. That's what I'm trying to say. So you need to understand all that. Yeah, you need to understand all that. First things first, you need to understand it, and you know, please mute your mic. Yeah. So this is the first entry model. Entry model one. I'll name this one entry model one. Entry model one. Entry model one. And this is entry model two here, right here. Entry model two. Entry model two. Entry model two. Now this is just the basic model I use. This is the least effective one I use while trading. and I mostly use this on gold. It's least effective, meaning this is not a liquidity entry model. There's no liquidity sometimes, most of them, but I just enter directly when it's mitigated, regardless of whether there's liquidity or not. But if there happens to be liquidity, that will make the zone higher probability. Liquidity in the sense that I'm talking about, price did something like this, but then did something like this, creating this liquidity here, which will serve like as an inducement here. Some people will be entering from here. Some people will be looking to do this. Some people will be looking to sell from this zone here. They'll be expecting price to crash when price comes back to this zone. Yeah. So now, eventually, if price doesn't hold in this zone, now if price doesn't hold in this zone, I'll be looking to monitor. If I see reaction from this zone, I'll take the sell. But if it doesn't and it goes down here, it will make this zone a stronger zone to sell off from. I'll show you guys some examples on the chart soon enough. So this is the first thing I wanted to explain to you guys. This is a liquidity entry model. This one has liquidity, and but basically it's not all the time it must have liquidity. This one doesn't have liquidity, but I'll still take the buy. And whenever I do this, I only target 3 RR. It's only when I see liquidity that I'll target my normal 5 RR. Yeah, and that's liquidity. I mean something like this. There will be a low before this zone here, so I'll be expecting price to come back in and buy from there. That kind of thing. So in this kind of case. And now, another thing I wanted to give you guys information on, take note of, is you don't just draw out your SBRs and RBS from any point on the chart. These two things I said I call them SBR and RBS. Take notes. So I'm coming. Let me move this out of the chart to the center so you guys can see everything. Yeah. How did I get that stuff from? Yeah. So let me take this back here to my chart. Yeah. So this is the entry models. These are the entry models. Basically everything you need to. So the two entry models that I'll be giving in this class, and I'll be explaining the last one, which is the most powerful after we cover these two ones. But you guys should just stay active and follow along with me. So now I'll re-explain this for people that are just coming in. This is a point on the chart. As I told you, nothing moves straight in the market. You can never see price doing like this. Price moves in waves. In waves, in order to do what? To seek liquidity, energy to move up, because it can only ever move up for a period of time before it will lose its buying power and it begin to fall back down and crash. So that's why it always does this. Whatever you can call it as a beginner to understand it, you can call it zigzag. You can say that. Uh, um, yeah. So as we're saying again, back to this now. Sorry, sorry. Yeah. So this is entry model one, and this is entry model two. I explained earlier on. So now these two I call SBRs and RBS. Entry model one. This one here is I'll call this is the RBS, entry model one, RBS. What you're seeing up here. Let me make it full screen here. What you're seeing up here, SBR, RBS and SBR. So this is entry model one, RBS, and this is entry model two, SBR. Support, break, resistance. So basically what I mean by that is there'll be, the first one, RBS, there'll be a resistance level, this key level here, this high where price failed to respect, price failed to do this, price failed to crash from that level. This resistance, resist means prevent something from happening. You're resisting something. Price failed to fall back from there. Instead, price did this. Sorry. Instead, price did this. Price shot up, broke it, came back down, mitigated it, and continued buying up. So basically, I would have done something like this, entered here and targeted a 3 hour, cover a week in order to make sure I'm not, I don't get taken out. I'll explain all that briefly. Just give me a sec. So then the next thing I told you guys, RBS. So this is RBS, resistance here, resistance break. This is the break here. This entire zone that failed to hold. Price shot up, broke it, and then this resistance turned to support. And when you're saying support, you mean you want something to go higher. You know, if you're supporting a friend or a brother, you want that person to go higher in life. So this resistance point now becomes support. It flips the intention or the purpose of that zone. The roles reverse. It reverses for to become a zone for a buy. Now you only do this when you're in an uptrend or in a downtrend. Same thing for this. In this SBR, in this SBR here, this is the support level. Price went up. Price made a break of structure, and then price came back down before tapping it. Price then did this. Sorry, price then did this. Came back up here. Failed to come back down. Sorry, price then did this. Came back here and crashed from there. So basically, this role reversed. Ordinarily in the forex markets or in trading, this should have happened, but probably this did not work out because there was no liquidity before entry, so price just tanked, or it was just a generally bearish trend. There can be any reason behind that, so you need to understand the rules. So now this serves as liquidity, and this will make the zone stronger. So someone that understands this model would be targeting or be predicting a buy, sorry, a sell from here. So this support becomes resistance. SBR, support break resistance. This is the support level here. Same way I marked it out for the RBS. This support level here. Price went up from here. Then price came back down here. And then it failed to go up. Sorry, it failed to go up again, came down, went down again. This created some kind of liquidity level, inducement, and inducement. So some people will be looking to sell from here, and then price will come in here, take this, and become a resistance level. So support, break, this is the break, this straight line over here, this is the break, break, and that support becomes resistance, becomes an SBR. So these are the two entry models, entry model 1, entry model 2. The last but not the least, which is the most important entry model I use, and I target 5RR whenever I see these entry models, is the liquidity entry models. So basically, these are the two things. Sorry, these are the two things now. This is entry model 1, entry model 2. I'll show you guys how to use them shortly. I just want to narrate how they're used now. So entry model, this is another entry model. Liquidity entry model. I'll call this liquidity entry model. This gives you higher probability trade. Higher probability or yeah, probability trades. So you can risk more on this trade to get better money. So let me show you guys how this type of trades work. So basically we're going to have something like a trend. Let's say we're in an uptrend here. Yeah, we're in an uptrend here. We're going like this. Price is creating higher highs, higher lows. Yeah. Now what we're looking to see some kind of things now is this. Price will do this action. I'll explain to you guys shortly. Now, this is liquidity. I'll give you guys liquidity entry model one. Let me type it out. So just take note of all these things, or you can screenshot and get back to them later. Liquidity entry model. I'll just call liquidity LQ to avoid typing it out long. Entry model one, and this is called QMR. This is what they call QMR, or a this is what people call a QMR. Don't mind all this pre-price of stuff that I did, all these drawings I did from this point before. It's not necessary. From here, it's not necessary. Don't pay attention to them. I just drew it for the sake of narrating that okay, market is going up in this uptrend. So now just pay attention to this part here from after this box here upwards. So basically, now this is what we are talking about in terms of liquidity entry model. Entry model one. This entry model one. So entry model one is going to look like this. I'm coming. Yeah. So this is how it's going to look like. Basically, price will do something like this on the chart. You're going to see something like this. It's moving an uptrend. This is optional. It doesn't always happen, or it doesn't always need to happen. But whenever this happens, it creates higher probability whereby price to take out a low, then move up. It will move up, not just moving up. It will cause a break of structure. A break of structure, I believe everyone here already knows basics of trading, please. A break of structure is when price breaks a previous high. So now, in this case now, in this RBS here, this is a break of structure. You need to understand that this is a break of structure. Where is that stuff? Sorry, having difficulty locating this line. This is a break of structure. Price broke a previous tip to the upside. So this is a break of structure. That's the first thing you need to understand. Let me remove this so you guys can just understand. So this is a break of structure. BOS. Let me align this in the middle, in the center, so you guys can see it here. So yeah, this is a break of structure. BOS. Uh, I'm removing this, the all this, so you guys can just see better. So a break of structure is when price breaks either a high or a low on the chart. So now this is price broke this low here. So this was a break of structure to the downside. Then price broke this high. This was a break of structure to the upside. Similarly, when we took this trade, we entered from here. Price broke another high again and created a second another BOS, a second BOS to the upside. So break of structure means BOS. You're going to see this everywhere on YouTube, every single way you go to learn. So this is an important one of the most important terms in trading: break of structure, BOS. So these are the initials. This is what we use for the initials. There's no other initial we use to identify or address these. So just understand that this is a break of structure, yeah, and so on and so forth. So anytime price takes out a high or a low, a break of structure is made. This was a low here, price took out this low, a break of structure was made. This was a high here, price took out this high, a break of structure was made. This was another high here, price took out that high, a break of structure was made, and so on and so forth. That's how break of structures happen on the charts. So basically, this is a break of structure here. This is another break of structure right here at this point. At this point here. So this is another break of structure here. So break of structures happen everywhere on the charts. You just need to know how you identify them. And what I tell you about identify them, just know or locate wherever price took out a high or a low. Wherever price took out meaning price shot up past that level, creating a new high or a new low, respectively. If it's in a downtrend, it's the inverse case. If I flip this upside down, let me flip the chart. You can see this now. Break of structure is to the downside. This is a downward trend. So uh this is the entry model I was trying to explain, or I was talking about first. Let me explain how it looks like. So basically, you're going to have something like this now, whereby price made a break of structure, took out a high, creating a break of structure. Price then came back, created an inducement leg. Why we call this inducement? Inducement means like to force somebody or make somebody do something or make something to happen. So this inducement makes people to want to buy from this level. So now these people who want to buy from this level, meaning people would open buy positions, people would click buy BTC USD, buy XA USD, buy this, buy Solana USD, and so on and so forth. People will be looking to buy from here, and this is what will happen. Price to take them out. Price takes them out. They'll be looking to buy from it to target somewhere up here. Price then takes them out, comes back, comes down here, and mitigates, and it then mitigates an order block from this level here. It will mitigate an order block here and then buy, rather than respecting those people's first order block. These people that bought here, they were used as liquidity. So markets use their. I'm trying to explain all this in a way a beginner will understand, but you shouldn't be a beginner here. Everybody should get that. So basically, this whenever a break of structure happens in the market, you need to understand that the an order block is created. You go to your time frame and you find a candlestick that you use as your order block, or rather when a break of structure is created to the upside, a demand zone is formed. This entire area here below the 50% of your Fibonacci or your Gann box 2 is your supply zone, so is your demand zone. A demand zone, I believe anybody that here that is an economic student should understand what demand zones are. You know, supply and demand is a topic in economics. When demand is higher than supply, price goes up. When supply is higher than demand, price falls, price crashes. So a short explanation I like to use as a narrative is in a market where you have banana sellers, for instance, you're in a community or you're in a village, and there are banana sellers now. Now, if there are only two people who rear bananas, or let's say rear, who grow the plantation, the banana in that village, and now bring it to the market to sell, what do you think will happen? Because there are only two people who produce bananas in their backyards and sell it in the market, you know, it means that the supply of bananas will be limited. And when supply is limited, if the people in the community are now larger than the amount of bananas, not just people, if the demand, if the people's demand for bananas, they want to eat bananas here and there now and then, if their demand is now larger than the amount that is always supplied, let's say on a weekly basis or on a daily basis or any timely basis, you get that. Now that will mean demand is higher than supply. So now demand becomes higher than supply in that sense, and it can only mean one thing: the price of banana will do what? Price of banana will skyrocket because it's limited. You get now? This is a common. If you try to wrap your head around this, take the video back if you need to. This video will be posted on YouTube, so you guys can go. So now, basically, what this means is that price of banana will do one thing. Price of banana will do one thing. It will do this: skyrocket, because the demand for it is high and the supply, people supplying it, is low. That's the same thing what happens when what happen we you guys, I'm sure everyone here has experienced for scarcity period in the countries now and then. Happens periodically. Sometimes country can just shut down temporarily and all those kind of things. So whenever there's forced scarcity, what do you observe that the all these adults are always shouting about or complaining about? I hear that there some of them self will be leaving their cars at home and be entering public transport or this and that because people selling fuel, filling stations are out of fuel. And now because filling stations are out of fuel, you now see the filling stations that have fuel, they'll be doing buga. If the normal price of fuel is 950, Those people can conveniently say we're selling our fuel at 1,200, and now people will be lining up to buy that fuel. Why? Because there are no other places to bargain at a lower price for that fuel. The same ideology is used behind the banana market. In the inverse case, if the supply of banana is much, let's say there are 100 people that grow banana in a community that the population is just roughly like 500 people. Now 100 people grow and sell bananas. What do you think will happen? The supply of bananas is will be much. Bananas will be abundant in the market. Everybody will be seeing bananas. People will even get tired of eating it. So now what will happen to banana? The value of banana will reduce, meaning that the supply is larger than the demand. People are no longer there's demand, there's always demand, yes, but the demand is lower, significantly lower to the amount of supply. So it leads to plenty things, banana spoiling, this and that, and so on and so forth with time. So when supply is higher than demand, it only gives one scenario: this markets will crash, markets will become bearish, market will crash. So now this is the concept behind supply and demand. Just try to get that around your head and understand it. And so back to what I was saying. Whenever a break of structure on the charts now, whenever a break of structure happens, a to the upside, in this case now, market is going up, market is bullish. Whenever a break of structure happens to the upside, a demand zone is created. This entire area here. Now, there's a tool that you always have to use, make use of, which is very important in your trading career and everything, which is this. Now, this Fibonacci tool, it basically marks out levels on the chart. So sometimes it might look confusing, like what's this rainbow tool and everything. Just now, the most important points are these 3 points: the 0.5 level, the 0 level, and the 1 level. Now, anything above the 0.5 level is a premium level. Anything below the 0.5 level is a discount level. That brings us to the topic of premium and discount. We're just taking that shortly. Premium and discount. Discount. So basically, when you want to buy, you're only looking for discount zones. Discount meaning, okay, you go to the market to buy something, and the seller will first tell you a higher price with the thinking or with the inclination that this guy will want to bargain. So let me start at the higher price. The seller will tell you, we're buying the price of one banana. Look to the right of the chart. The price of one banana is 4,500 naira. Let's say this is naira now. This is dollars, or this is gold chart, gold USD. So let's say this is 4,500 naira here. This is what the seller will tell you. This is the opening price the seller will tell you. You as someone will be like, boss, no be 4,500. So, or let's say the guy said, yes, this is 4,570 naira. You now say, boss, this thing, I don't get that kind of money. Oh. This is 4,570 right here. If you look at the chart towards the right side, you obviously tell the person, Alpha, reduce price for me now. Now, this zone here, that's what happens here now. People want to wait, buyers want to wait for price to come lower to get a good opportunity to buy in the market. So now what these buyers will do is wait for a discount level to appear on the chart, meaning when there's a break of structure, for instance, this is here. When there's a break of structure, there are 2 points that have been created on the chart now. This low, this is the low, and this is the high, this new high. You can see there's a new high that's been formed here. So now from this low to this new high, you take out your Fibonacci tool, or let me use another tool so you guys not be confused with this Fibonacci. You can use your Gann box tool. This is this tool. So I have edited mine to just display only 2 points or 3 points, which is the 0.5 level, the what do you call it, the 0.5 level, the one level, and the 0 level. So basically what I use this tool to do is just to mark or denote out premium and discount levels. And I told you guys, discount levels are levels below the 50% in terms of when you're buying, while premium these levels are levels above the 50%, which is 0.5. From 0.5 to 1 is the premium level. From 0.5 down to 0 is the discount level. So this is where buyers look to buy. And look at what happened exactly. When price went up, price came back all the way down below a 50%, half of what the price went to from this period to this period. Price came back to half of what the price went to before going up. That's how market moves. Market moves in the direction of premium and discount. So now when market is buying, you look for discount zones, zones below the 50%. And in the inverse case, when market is selling, in this kind of case, when market is selling, meaning from this period to this period, my price moved from this price to this price within this period. This could be 1 month period on the chart. This could be 30 minutes period and so on and so forth. So now this period, within this period, price move from here to here. This will create a supply. So this will create a supply level because price crashed. As I told you guys, supply is the opposite of demand. In a rising market, demand is at the bottom going to the top. While in a crashing market, supply is at the top going to the bottom. This will create a supply level here, a supply zone. This is what they call it, supply zone or supply level, anything you want to call it. So now this creates a supply zone, giving us what exactly now? Giving us this. This created a supply zone. Why? It created a supply zone because market broke structure. As I told you guys, supply zones and demand zones are only created when market breaks structure. Another thing to note down. A break. Sorry. When yeah. So you need to have a break of structure. First things first, you find a break of structure. Let's just make it a checklist so that you guys can understand or remember things better. Number one, spot break of structures on the chart. Let me reduce the font size because it's too large. Uh, let's reduce it to something like 11. No, it's too small. 18. Nah, 14. So the first rule I tell you guys, spot a BOS of the chart in order to find a valid supply zone or a valid demand zone. In order to find, or rather, to find a solid supply zone, supply, supply zone. Okay, supply zone. Let's have supply zone. Supply zone. First, spot a break of structure on the chart to the downside. Yeah, to the downside. Downside here. Yeah, that's the first thing to do. Now, whenever there's a break of structure to the downside here, you have only one step completed, which is uh, the first step. The second step you need to do now is to mark your premium and discount level. Mark your premium and discount levels. Mark your premium and discount levels using your Fibonacci tool. Fibonacci, how do you spell it? Forgot how to spell it, so in case I spell it wrongly, using your Fibonacci tool to find a valid here, find a valid supply zone, a valid supply zone, a valid supply zone here. So that's the second step. You mark it out. You mark out your 50% level, which is what I did here. This is the two. So now within this move from up here to down here, 50% of that move ended here. So 50% of that move was here. So now what this created now is above this 50% is a premium level. Premium meaning is a good level to sell from. Is a high price. So now within this level now, you then find the third step I'll tell you guys is to find an order block to sell from. To sell from. So another block to sell from. Another block is basically the last bullish candle before price came down. I'll explain that to you guys later, but just last bullish candle, last bullish candle, candle or week is another thing I'll actually have to explain. But this is an advanced of week. But let me just say that. find another block to sell from. Then the fourth thing, which will make your setup higher probability, wait for liquidity. Make sure, or let's say, find, make sure, let me just say, make sure there is a valid, or let me say strong liquidity, valid liquidity. It can be inducements, or engineered liquidity below the supply zone. Either one of these two below the supply zone. So when this happens, when you get this checklist as well below the supply zone, and now this valid liquidity is going to be another supply zone. For instance, this case now, you can see this is another supply zone here because markets created another break of structure. If you look very well, markets created another break of structure here. So markets created another break of structure here, another break of structure to the downside. So this is another break of structure. So basically, this is another supply zone. Supply zones are formed everywhere. You get what I'm saying? So now, what makes us take a trade from a supply zone is when there are confluences, meaning when there is liquidity. For instance, this is an inducement because people will be selling from here. So people will begin selling from here. The early sellers begin selling from here, and they will get taken out. Price will take them out, and they will lose their money. This is what will happen. Price will come in here, react a bit, then do something like this, enter this OB, and then finally sell off down. You get, this is what price will do. So now these people here were used as inducements. This entire supply zone is an inducement because there's another supply zone directly above it. So you need to understand that. So basically what I'm trying to say is that whenever you want to enter a trade, don't just find a supply zone. Now wait for a supply zone. Now this is a supply zone. A supply zone has formed, but now what makes you more confident in that trade is when you see liquidity or inducement. As I wrote here, make sure there's a valid liquidity point, in brackets, inducement, inducement or engineered liquidity below the supply zone. So this is what it is now. So now what you do is you wait for there to be this was the first supply zone that formed. So you won't just trade from this supply zone again. You wait. If there was an unmitigated order block here in the first supply zone, that's where you use as your entry when price gets back there the next time to sell from. Rather, so this is what I'm talking about. You don't just jump in on a trade. And one thing you need to learn as a trader is to be patient. Don't FOMO, because price will always come back for sure. So don't even fear. All those people that will say, oh, price has left you out and all those things, don't fear. It's not what do you call it, it's not true. Price hasn't left you out. You that is trading the safer way, you end up losing less money overall on all your trades and making way more because you traded smarter and safer. So liquidity gives you higher probability trades. This is an inducement here, an inducement leg, because price broke another structure down here. So this creates an inducement leg now for you to sell from. Price will do this, take out all these people that are selling already from this zone here. Take them out. Use that one as fuel. Basically, what you need to understand what liquidity is. Liquidity is fuel. Without liquidity, market cannot move. Liquidity is money. Anytime you say liquid, if they ask you, do you have any liquid assets? You get, means things that generate revenue readily. You get. So basically, you don't just trade off any supply or any supply zones, because that will make you ultimately to lose more cash. If you don't do that, it's not how you trade. You don't trade off supply zones. That's not how you trade. Yeah. So basically, next thing now I'll have to tell you guys is this is what you have to do now. So understand how this works. This is just for supply. Oh. We haven't even gotten to demand zones, but demand zones are basically opposite. Just flip the chart in your head. This is what happens when price is creating break of structures to the upside. You can see this is break of structure one. When a break of structure happens, what did I tell you guys happens? When a break of structure to the upside happens, a demand zone is formed. Demand zone formed. This is the opposite case of supply zone. A demand zone formed here. So we don't just trade off it. If price came here and did this first, we won't just trade off it. You know, we won't just trade off it. This we won't just trade off it. If eventually it goes up, that is their luck. You get. We wait for a liquidity to form, but whenever it does that, it can even be all the way down here. We wait patiently. We don't just trade. You get. We wait to find liquidity in the market so that we can be more confident in our trades. So now this will happen. This will happen, and then price will go all the way up there. Damn. That's how we. This is how it does. This is how it goes rather, and this is what you'll be expecting on that trade. You cover the last low here when you're trading. Cover the last low and you target somewhere, maybe the high. Or target the 5 hour basically. So this is how I trade supply zones using liquidity. And what remember what I told you guys at the entry this thing. Liquidity entry models are higher probability. Liquidity entry models, higher probability trades. That's why I wrote them here. This is liquidity entry model. This is the first one for buys, and this is for sells. Yeah. So understand all this. Find the value supply zone. This is for supply zone. Uh, for demand zone, this is basically what do you call it? This is basically what you do. So let me change the wordings. To find a valid demand zone, what I'll type here. Find a valid demand zone, demand zone. Spot a break of structure to the upside. It's just opposites, vice versa of everything. Press one. Mark your premium and discount levels using your Fibonacci. So you only look for a buy at your a premium or discount level. Then you find another block to sell from. The last bullish. This is in this inverse case. This will be the last bearish case. Sorry, the last bearish candle. Bearish candle, candle or week uh, before the upwards move. Upwards move. I'll show you guys all the examples now and how I've used all of this to make crazy money over the months. So uh before the upwards rally, you get. So then make sure there is a valid liquidity above, I'll say above liquidity points, or rather liquidity level above the demand zone. Yeah, let me take that out a bit. Above the demand zone. So market premium and discount levels using your Fibonacci tool, your Fibonacci or Gann tool. There are different tools to trade on TradingView. So sorry, to use to trade your Fibonacci, using your Fibonacci or Gann tool. Sorry, or Gann tool. Yeah. So the next thing now you need to understand is find another block to sell from. I'm changing. Sorry, this is to buy from because this is for buys. This is for a demand zone to buy from. To buy from, and that's his last bearish candle week. This will be last bullish candle of week. Last bullish candle. Screenshot this when I'm done typing. Last bullish candle of week before the downwards. This one is downwards. For the downwards move. Yeah. Then make sure there's a valid liquidity zone, inducement or engineered liquidity below the supply zone. Yeah. So that's how what they call it. So let me get that now. Inducement or engineered liquidity. Sorry for this long typing, but it's necessary. It's necessary. So before the downwards move and before the upwards move, I just want to make sure the English is correct. Don't mind downwards move. So now they said find another block to buy from. Make sure there is a valid liquidity level. You get liquidity zone be above the edge, above the demand zone. So let's just recap on that. Then we'll get to the charts now. So now this is what we're saying. Uh, the first things first, we find break of structures on the charts, as we said. When market is moving its normal way, this is a break of structure. You know what I'm saying? This is a break of structure. Oh damn. So this is a break of structure coming. This here is a break of structure. Switch my window. So call ends in 15 minutes. Whoever that's on my Telegram channel, you'll be able to see the second link I'll drop there. So you join back, then we get 1 more hour before we end this class. So for whoever that's still willing to stay, whenever that happens, yeah. So now next to this stuff, please mute your mic, whoever that's just joined. So make sure you join the Telegram group. You see the link, the second link I'll drop there immediately after this call ends. We'll continue, so we can continue with another time. Google Meet doesn't allow long, So I'll drop a second link instantly when this call ends. So back to what we're saying here. The first thing to do is find the valid supplies on blah 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 blah. So now basically, this is what we're talking about: the liquidity entry model. A break of structure to the upside. This is called a QMR, liquidity entry model one, QMR. Find a break to the upside, then you wait for an inducement form, an inducement or engineered liquidity. We've only looked at inducement, which is this level here, which price uses to take people out, use them as liquidity before market actually buys up to the higher side. In this case now, we can see this is the opposite one, whereby there was a break of structure to the upside. And remember what I told you, a break of structure means what? A supply zone. So a break of structure gives what? A supply or demand zone. So in this case, market went down. So this is a supply zone. So now we need liquidity to enter the supply zone with confidence. We don't just enter anyhow. So this is an inducement, as I wrote here, inducement or engineered liquidity. Now let's look at engineered liquidity together quickly, so we can just know how engineered liquidity looks like. Now there are cases whereby market will just do something like this. This is a bullish market. Price is going up, price is going higher, price is going higher. So now price will do something like this. And now you can enter this trade only if it gives you an engineered liquidity. If it doesn't give you an inducement leg like this, and which creates a second break of structure, an inducement meaning that there's another demand zone above this other one. If it doesn't do that, this is why it doesn't do that. So if it doesn't do that, there can only be one thing that will happen for you to be confident before entering this trade, which is an engineered liquidity. So now basically, engineered liquidity is the last low price to make before mitigating your order block. Now let me explain to you guys. So now this is what we call engineered liquidity. This is the interesting part. I love whenever this happens on the charts. It makes me so happy. Like I don't know. I enjoy engineered liquidity entry models better than inducement entry models because inducement entry models are just easy. I know, but liquidity entry model you have to be, a pro to understand how it works. So that's why I just love it. So sorry, don't look at this in my chat, my WhatsApp chat. Don't mind me. Oh. So, anyways, uh this is what I mean by an engineered liquidity before entering. So now, as you can see, price did a break of structure, which was this first step, step one. Let's go through the steps together now. Price did a break of structure. This was a break of structure here. Price did it. What was the second step that we wrote there? Spot a break of structure on the chart here for a demand zone. Spot a break of structure on the chart. Mark your premium and discount level using your Fibonacci or Gantt tool. So now, as we were saying, this is something uh, that you have to do. Always mark your premium and discount level. Always to find out where is okay before price begins buying from, or to find your targets. For instance, if you were selling from this high now, you can decide to sell to any point before the 50% because from this point below the 50%, price can immediately just shoot up like that without even coming down again. So this can also be used for you to find your targets and so on and so forth. So now, second thing, mark your premium and discount level. So now we found out that from below this leg here, this entire zone down here is a good opportunity to buy from because it's a discount zone. Let me take away this tool. So we've already found out our discount zone is this entire level area below here that we're expecting price to continue buying up from any level below here. So now that's not just all. Remember, we have a checklist. We now have to find an order block to buy from, last, which is the last bearish candle or wick before the upwards move. So then we find out, we mark out various order blocks. There can be tens and hundreds of order blocks on this thing. There can be another block here. There can be another block here. Any level here, other blocks will be created. You just be seeing bearish candles creating and forming fake order blocks and all. The only time you enter the market is when you liquidity is created. So in this case now, markets did not do this creating an inducement leg. Market did not do this create an inducement leg for it to come down, take out and buy from. Market did not do that. Market is just coming straight down. So now this is the second case whereby I wrote, after you find an order block, make sure there is a valid liquidity zone. And I wrote here in brackets, engineered or inducements. Yeah, I wrote here in brackets, engineered or inducements, engineered liquidity, LQ. That's what I mean by LQ here. Engineered liquidity are above the demand zone. So now, as I told you guys, there are various demand zones here. This entire level, which is the discount zone that we're looking for price to reverse from, we're going to be observing all the demand zones here and looking for any liquidity to form above the demand zone for us to know, okay, yes, price will begin buying from this point. As I told you guys, all this level here, which is the discount zone, all these areas here, they are valid areas for price, valid potential areas for price to begin buying from, and they can be demand zones all everywhere. They can be order blocks everywhere here. Order blocks can fill everywhere here, as I explained to you guys before. But all these other blocks will fail. Why? Because there's no fuel for it to push up to the upside completely. So now people that don't understand this will buy early, get larger stop losses. But you, as a trader that understands, always be patient, never rush because price will come back no matter what. When it gives you an engineered liquidity like this, price come back to mitigate that other block and buy crazily. This alone can make you so much money. I'm not over exaggerating because this thing is just so powerful. You get this, and I always target a 5 RR at least, or this thing gives me. I always target either a 5 RR or the what they call it, or the swing high. For instance, this now instead of a 5 RR, I would have collected a 7.6 RR. This is risk to reward, which means that if I risked $100, I'll be gaining $700, which is 1 million naira, one point something, and so on and so forth. So that is what RR means, 7.6, because this is 7.6 RR. So anything I risk, I'll be gaining 7.6 times the amount. That's what RR means, risk to reward. That's what it's written here, in case anybody here doesn't know. So now you find all the other blocks on this demand zone, which was the third step I wrote. Find another block to buy from. Mark out all the other blocks if you need to, or if you're just good in looking, that's fine. Which is last bearish candle before last bearish candle or week before the upwards move, and so on and so forth. So now, as I was saying, this is what we call an engineered liquidity. Whenever price, price when price is coming down, price will just come down straight. As I told you, price does not move straight. I'm just drawing these things for illustration, so we don't have to overdraw things. So now this is what how price will be moving. Price will be moving like this, 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 and so on and so forth. Once it finally comes down here, so you guys got to understand that. So price moving in zigzag coming down here. Now until price forms an engineered liquidity, which is the last low before the mitigation of an order block. And now there's a criteria. That low must create a break of structure, meaning that low must break a high. That low must break a previous high that was formed here. When this happens now, just know that yes, you have hit jackpot. You're going to buy from this zone here and target the swing high or 5 hour or whatever your what do you call it is, whatever your plan is, your trading plan, your rules are. So now when this has happened now, as you can see, this is where all the other blocks to buy from. Normal retail traders, everybody would have done something like this. Some people that don't use liquidity trade, they just mark out other blocks and trade them blindly and take losses here and there from time to time. When they are lucky, they don't take losses. They would have entered from somewhere like here or here, anywhere, because it could have been a fat ass week on the higher time frame, but you go on the lower time frame and you find. And then another thing, another secret I have to tell you guys is if you don't see a valid order block on a higher time frame, keep going down to lower time frames and spot valid order blocks. What I mean by that is if there's no inducement, if it's in the case of you are looking for engineered liquidity, go down to lower time frames until you find other blocks that have not been mitigated, and you monitor for what price does above those other blocks. When price gives you an engineered liquidity, which is this now, price did a break of structure, price broke structure here. So now, which creates a trap for people. Some people will now say, okay, people on the lower time frame, let's say 1 minute or 2 minutes or 5 minutes, say, okay, let me buy from here and target this high, like that. They'll say, let me buy from here and target this high here. It's just good no now. Now this will use them as liquidity. They'll take, they'll lose their money. Look at what happens. Their stop loss gets taken out. Then it taps into this order block and then it buys up. That's the way this stuff moves. That's the way the market moves. Market always seeks liquidity. And if you don't spot the liquidity, you keep donating your money. Donating meaning you keep losing your money, you keep losing everything, your salary. Be saying to get better. My brother, sometimes things don't get better, okay? Things get worse throughout. Hmm. If you don't want to learn or find the right knowledge or person to learn from, you get, always learn from who you know that knows road, or at least is doing well, and you have seen the person's works, not just from the person tell you, give me your money, let me trade for you. And never give someone your money to trade for you. Trade by yourself, please. Just like in this market, you yourself, you are the best trader. Nobody knows better than you because all these gurus out there is crazy. So now will serve as what I call an engineered liquidity. In this case now, this will give you what we call an engineered liquidity. Let me write it down. Engineered liquidity. Liquidity. So let me take it to the right. Oh, I'm coming. Oh, no. I haven't created this thing yet. Sorry. Top right. Yeah, let me move it to the right. So this will create what we call an engineered liquidity for you to enter the trade using this order block validly. Why did this trade play out well? Because markets, this was a low that created a break of structure to the upside. Market created a break of structure to the upside. This created a break of structure on the larger swing. Then it did not create any inducement leg, so we waited for an engineered liquidity to form, which was this. In this case now, as you can see, an engineered liquidity formed. Engineered liquidity is used for trapping people. So now these people lose their money while your trade gets triggered, and then your trade goes to the target profit, which is this here, which is that there. So you gain all this. How much you gain? This is the reality. This is real. It's not fake or anything. I'm not just making things up. So now, people that don't trade, that did not wait for that to happen. Yeah, let me create another link for them. Rejoin the call, guys. Yeah. Isakala Buma E. Isakala Buma E. Isakala Buma E. Isakala Buma E. Yeah, back to where we were. Welcome back, guys. So now, as where we were the last time, so now people will begin coming. Let me get back to this area here. So that's what we're saying again. Now, these people would begin. We're saying these people begin buying on time, which thereby reduces their risk to reward because their stop loss is wide. For instance, the stop loss is the same place as a stop loss was, but now these people are entering later. That's why you don't just buy from any random 4 hours supply zone we are seeing there. You wait for a what do you call it, for an engineered liquidity to form. Sometimes the engineered liquidity can form on the 4 hours or any time frame. Whichever time frame it forms, the other block below that engineered liquidity is where you are entering from. That's the most important thing you should note. Whenever an engineered liquidity forms, the other block below that engineered liquidity is where you are buying from. In the vice versa case of sales, when you are selling the market, when the engineered liquidity forms, the other block above the engineered liquidity is where you are selling from. So, as we're saying, now these people that bought on time because they don't have the knowledge of what they call it, other blocks and engineered liquidity. Now they'll be second guessing, like they'll be guessing, okay, let's just buy from this entire zone area here like this, and that's why they end up with poorer RRs than traders that understand this concept. And see how here we easily cut a 9 RR, and this is no cap. This happened to me last 2 weeks. So now this is the most powerful entry model. I told you guys it's the same case, vice versa for sales. Let me just mark it out quickly, as quick as possible. We don't have time to waste. So in the case of sales now, as you can see, this will be a sell here. Markets failed to create any inducement leg, but rather markets is just coming back up into the supply zone slowly, doing all this and that. So now, so what we're expecting to happen now before market comes back down here. So I just drew this out to narrate, to illustrate to you guys that market doesn't move like this in a straight line. I'm just drawing all this for narrative purposes. I believe you guys understand the intentions behind this. So now this is exactly what we're talking about. Mind you, sometimes market will just come in and tap this thing. Don't think about that though. Don't buy, sell, or buy from that zone, because you can easily just do that to pretend to buy, or to pretend to be selling, and eventually come and take you out because there was no liquidity in that zone, meaning no driving intention for price to actually stick to that supply zone. It's a valid supply zone. It created a huge crash. Markets will definitely react, but it won't give you that full movement, and it's not as safe as trading when you have an engineered liquidity. So this is your engineered liquidity here, because market took out that low there. You get what I'm saying? Let me make this a tool of mine. Add it, save as engineered liquidity. Engineered liquidity. Yeah. So let's get that engineered liquidity. So it's saved here. Okay. So now let me say this one's engineered liquidity. Engineered liquidity. Yeah, so this is an engineered liquidity here, meaning this high here will serve as trap for people to get out of, and then us to enter the market and sell from. Yeah, so then we're going to sell from here, cover this high here, and then you know target this distance here. So this is how we use engineered liquidity for trading. This is in the case where there are no inducement legs. This is inducement in this case. We just trade normally, quick trade. Engineered liquidities give faster trades from what I've noticed. So you always understand that. And also, in this case, make sure there is no unfilled order block above your POI. This is your POI here. Make sure there's no unfilled order block. If there happens to be any single unfilled order block here, above that, above this entry, know that is you. Now you be the liquidity this time around. You get. Make sure there's no unfilled order block. Even if there's any unfilled order block, make sure it's far away. You get, or make sure they are just in the same zone like this now. You get, a market has come to tap into it, or make sure it's far away, like it's not near. You get, so when it's far away, it's going to create a safer space and a cushion to make sure to make sure that yes, you don't get trapped. So this is the basic model. Engineer liquidity, market is coming back to a supply zone. As I told you guys, the steps, get back to the steps, screenshot this, spot your BOS on the chart to the upside. Okay, this is for demand zone. Let's get the supply zone here. So can I just to find a valid supply zone to sell from. First things first, spot a BOS on the chart, which is what we did here. Spot a BOS. You guys can take this back, uh, watch it how many times you need, and get back to me on the feedback on the comment section. Dropping the video on YouTube, so it will be here, it will be there. So spot a break of structure on the chart to the downside. I've taught you guys on this or on the first call how to identify your BOS. Then mark your premium and discount levels using your Fibonacci or Gann box tool. So only be intending to buy or sell from 50% of whatever move you're looking at. So price moved from up here to down here within this period of time. So the discount zone is from this entire area. So this entire area are potential zones for price to begin selling off of. But we are trading and we're looking for high probability setup. So we can't just say let's sell from here. You get, obviously you'll make some money, but the money won't be worth it in the long run because you can't even be catching good moves. You get, so that's why we refine our entries with POIs. That's the intentions behind POIs. This is 50%. So this entire area from here all the way down here is what do you call it? A premium zone. Premium zones are good zones, or the only green flag zones. It's not a red flag zone to sell from. So from this area here, you you find all your other blocks in this area from this premium zone. Find all your other blocks. You mark them out. That's a very important thing. You mark down out your other blocks. You get, mark out your other blocks in this entire zone. Now, what was the next step that I wrote there again? So mark out, find another block to sell from. Mark out the other blocks you see in that entire premium zone. You get to sell from in the premium zone. Let me just write down in the premium zone. So other blocks, I just gave the definition in case of if there was any beginner there. As bullish candle or weak. Why I said weak is because sometimes it can be a huge as bullish candle, which doesn't give a minimal candle like an indecision candle or something to mark as your old OB. You just see a long straight candle, then a weak, then the next thing you will now see an indecision candle or maybe another downwards move straight back down. Whenever that happens, that week is your order block of any big move. I'll explain that to you guys using BTC now. So back to what we're saying. Uh, if you mark out your order blocks, you find another block to sell from in the premium zone. Then you make sure there's a valid liquidity zone below the supply level to take yourself from. So this is the blueprint. This will make you crazy money. I'm not over exaggerating, please. This will make you so much money. So just understand this and you're set in trading for life. Any market, this works perfectly. Engineer liquidity or what they write here, inducements. You get, let me write in the premium zone. In the premium zone. In the premium zone. So now you find any of these zones, any of these OBs, and if an engineered liquidity happens to form before any of these POIs, that's the POI you are buying from. because price might not get that last POI you are looking at or that last OB that you marked out. Any if the engineered liquidity forms before any of these POIs, that's where you are buying from, or that's where you're selling from. Or in this case, if the engineered liquidity formed before this POI, that's where we're selling from. And then we cover that OB's low candle week as our stop loss to target the high. We don't need to cover all the way down here again. From all my intensive back testing, it's not necessary. You get. So if the engineered liquidity, if this formed above this one here, this one would have been looking to enter from. That's if we looking to enter from and not cover this low. That is if you know the thing gave some kind of structure there. Like as I told you, this is not just going to be a straight line. This is going to be things like this now. You get. It's going to be things like this now. You get. So you mark out all the OBs there now. As I told you guys, it won't be like that, sharp. Because if it's like that, then it has already created an inducement leg. Well, let me just explain to you what I was talking about. Something like this now. This happens sometimes, but to be safer, you can still decide to just cover that place. So, as I said, if an engineered liquidity formed above this POI here, then you could have used that POI as your entry. You get to target the top rather than just on the higher time frame marking out one huge ass candle beam and targeting the top, giving you a lower risk reward by far. So that is the last entry model. Let us get to the charts, the fun parts now. I believe I've explained two entry models I use while trading. The first one, which was this SBRs and RBS, support turns to resistance. And in the case where there is a liquidity before the SBR or RBS, both in the same way. And last time I forgot to mention was that only make sure you are buying or selling from an SBR that is well in the discount zone in the case of a buy, while in the premium zone, only make sure that you are buying from a valid SBR or RBS that is in the premium zone. Likewise, both the same thing. Yes, always make sure for that. It's very, very important. So, this is the first here. Make sure the SBR is in the premium zone in the case of sell. Both tools, Fibonacci and GAN, they both do the same thing. You can use them interchangeably, whatever you need for any scenario. So I've successfully now explained uh, the entry models that I used, the two entry models, the engineered liquidity entry model, the QMR entry model, and so on and so forth. So QMR entry models, and I told you guys here, you can basically sell. This is not a QMR. This is a QMR. You get this is not a QMR. You can sell and buy from any zone. It doesn't really have to sweep liquidity before creating a break or structure. This just gives you a QMR entry. If it doesn't, that zone is still valid to sell from. Doesn't matter. You get what I'm saying? That QMR is just that QMR is just there for entry, for the sake of entry. It's not necessary at all. It's not necessary, but it just gives some kind of people say it gives a stronger POI or blah blah blah. But I don't believe in all that. It's not necessary because from all the backtesting I've done, all the sleepless nights, I've not deemed it as completely worthy or necessary. So now let's get to the charts and explore all this now where I don't talk. So go be like say I dey talk things wey no dey true. Now we are looking at what do they call it? We're looking at gold now, XAUUSD. So we're going to start from the 4 hours time frame. We always do a top. We always look outside to know what's going on. You get to understand. So now in this case now we know that let's start from here now. This October period, entering November, price was down here. So the price was all the way here. Price came down, and then we can see that okay, as price has come down now, price has created a new low and it wants to begin reversing. So first things first that I would do on any normal given day is to find out where the premium and discount zone in this entire range is, to know where I will be selling from or buying from in any period of time. You get. So now as soon as price did this, price came back into the premium zone ASAP. So any type of buy I'll be looking to take now, I'll be wary of it. If no, if it hadn't come here, I'll be free to take any buys. But any type of buy I'm looking to take now, I'll just be cautious of it. You get. If I'm taking a buy from a zone that caused a break of structure, I'll be very, very wary of that zone. So, first things first, now I know that okay, price has come back to this thing is premium zone, so I'll be looking for sells as well. And if price happens to come back down, at the same time, when price created this, when price came back to the premium zone, he also created this break of structure here. So which is the first step I told you guys, spot a break of structure. So now when it has created this break of structure now, that also gives us another zone again or another range again, which gives, let me just use the gun for this one instead. That in turn creates another range again that you need to understand and say, okay, this is a potential place to buy from if price ever gets back down to this level. You get, price went from here, did like this, so and broke the structure. So this entire zone here is a, this entire zone here is a valid zone. Say this entire zone here that broke structure here is, a leg that you can say, okay, a break of structure has happened, which was step one basically. That I told you guys, remember, step one, break of structure, right? Yeah. Spot your BOS on the charts, mark your premium and discount levels using your Fibonacci and toolbox. Find an order block, make sure there is liquidity. Yes, so that's the, we have done the first one as the second one. Mark your BOS, mark your premium and discount levels, find an order block to sell from. Yeah, order block. So BOS, premium discount level, OB, and liquidity. Those are the four rules. So four steps I gave. I wrote this out at the beginning of the call for you guys. So the same way we've marked the premium and discount level for this entire sell swing here, the same way we marked the premium and discount level for this new buy swing that has been created from here down here all the way here. So now when we go on the lower time frame, I have to tell you guys, when we go on the lower time frame, you guys to understand one thing now. You guys to understand one thing. Let's go on the lower time frame. Let me go on the 15, or let me go on the 31st. So this is the zone. I really don't want to remove all my analysis score. Looks like, yeah, let me just explain to you guys what I did when during this time, that time. So, as I said, we've marked out a premium and discount level for this entire swing from this leg here all the way down here. So we know this is the swing. We know from any zone here, we can be looking for sells when we see, an OB. You get what I'm saying? So, first thing I told you guys now, uh, mark out your premium and discount level, then mark out OBs on that. Sorry, find your a break or structure, mark out the premium and discount, then mark out OBs. Now this is what we're doing now, so you all can understand. Sorry, what am I doing? Yeah. So last bullish candle before a down move. As I told you, mark out all the OBs you can find. The only thing now that's left for you to do is make sure you only trade an OB that is in the premium level and also that has a liquidity that has formed, whether it's an inducement leg or whether it is an engineered liquidity. OBs are everywhere on this chart. You need to understand that. Sorry, on this swing, you need to understand that even the tip is an OB. You get to see an OB. This was a 4 hours OB, 4 hour OB. So that's the thing you need to understand. That was a 4 hour OB. So Remember what I told you guys that OB is any place that caused a break of structure. So this was the 4 hour OB for the overall swing of the 4 hour trend you get. So we would have needed to have an engineered liquidity on the larger swing, meaning for this now to have held, would have needed to have something like this now. Price to do something like this and come here and sell for that OB to have held. This is a 4 hour OB. That is not because if you look at that price action there, all those small things there, that cannot serve as liquidity. You get what I'm saying, right? You guys get right? So now that's what we're saying. And OB is anywhere a break of structure happened. So this was a break of structure here. The same thing, we repeat the same thing on the lower time frame. This was a break of structure here. This was a break of structure here, and so on and so forth. So another break of structure here, down here, another BOS. Let me move this to the left. Sorry. Yeah, this is another break of structure here, and so on and so forth. So we basically find inducements to enter from, to track people from. So now this is one example here. This one created an inducement leg. So this was an inducement. So we don't need to wait for an engineered liquidity to form. We can easily validate that yes, this is a good trade. Yeah. And remember I told you guys, whenever there is an inducement leg or something, you get make sure that there's no direct POI above that level, and a POI that is giving large wicks. As we can see, this POI now, can you see the wick? Large wicks. This is just pure inducement. You get this is another OB above this one. But if you look very well, how you can tell that this OB isn't a threat is the distance number one, and then what do you call it again? What I would just say is that this OB here, this entire leg here is not really like a proper leg to say okay this is an inducement for this one, you get. But regardless, this was a proper leg here. After this zone that broke structure here, price did this, created this proper leg all the way here, came back down again, so giving us this valid OB entry, which was this one here. So this gave us this now, giving us this as inducement. Remember how I drew it out before? Giving us this as inducement. And then we look to enter on the higher time frame. This was used that giving us as inducement. Then look, let's say higher time frame. Then we look to enter from this other block here. That's what we're doing. Yeah. We find the last bullish candle before the move to enter. And then we target a normal 5 RR. Yeah. If price was lucky for us to do that. But eventually it still actually did, but that's not the case right now. So as you can see, this is where your analysis comes to play. You need to understand how price works. It's not every time you target 5 hour. That's why you do top down analysis. Remember what we mapped out on the 5 minutes time frame, so on the 4 hours time frame. Remember what we mapped out on the 4 hours time frame, which was this new break of structure here. You get, look at the 4 hour time frame. Remember what we said. Remember what I said was that a new this thing had formed here. You get, a new swing had formed here from down here all the way to up here. Yeah, already like I said, from this low here to here, a new break of structure had formed. So if a new break of structure had formed, it means one thing: a new swing had also formed. So you need to understand that from this entire zone here, price was deemed to reverse at any point in time from there. So you only be lucky to be targeting a 5 hour. That's why you need to understand where price is heading to in both ways. As you can see, just this chart, I do not have any position to here because I didn't see this trade. Yeah, I would have taken it. This would have been a good trade. So please mute your mic, bro. Mute your mic. Well, I'll mute you first. So back to what I was saying. This entire zone was a discount zone. So price from this 50% here, you can see this is 50%. Price was deemed to reverse at any level. So remember I told you guys when you find your 50%, you mark out your OBs and everything. You necessarily don't have to mark them out, just spot them. You get what I'm saying? So in this case now, look at what I did that day. Let me remove this illustration. But I told you guys, you use candle wicks for entry if you can't find a valid OB that hasn't been mitigated yet. Let me explain to you guys. This was an entry from probably the was it the 1 hour that I gave that this thing? So yes, this is it exactly. So that's me how I discovered it though. And I just constant backtesting made me discover that thing. So back to where we were. What did I write here? Whenever there's a huge ass candle week, know that the OB where price react from the OB that person marked out of, well, it's reached the low, not low. I mean, it's reached the candle week section. Let me show you guys trades that have entered using candle wicks. People be like, bro, they enter with candle wick. That only happens when there's a huge ass candle. That's what I wrote here. Last bullish candle or week before the downwards move. This week there are criteria which I'll post on what do you call it on I'll post my trading checklists which I keep on my iOS notes. So I always these rules here are basically part of the checklist as well. But the checklist I'm talking about contains the criterias of the OB. I have an OB criteria notes set on my iOS notes. So everything I know how to mark out different OBs. I know how to mark out. I probably I get certificate for marking out OBs if that's the case because I've really worked on it very much. So I always get refined and good entries, bro. Like so, this is an example. I'm sure you guys using some signals I gave to. So first things first. This now, as you said, this entire zone here was now a discount zone from here all the way up here because this broke this structure here before tapping this other block and selling. You get so if you look at this here, sir, you can see that okay, this is an inducement leg compared to saying this is an inducement leg. But either ways, that is subjective. Somebody will argue, my boss, there's no way you would have known this and that, but I would have known because see how close this is to this area here. You can see, and we marked it on the lower time frame, so we got this more refined entry all the way up here. But either ways, let's get to it. So now, as I said, when you get to lower time frame, you mark out your order blocks. You mark out your order blocks. So we can see, I like marking out my order blocks with lines. Don't mind me, guys. I prefer lines than this thing. It's because of this code I'm using all these rectangles for you guys. But I prefer using lines. If you see my chart now, you can see. So I'll explain to you guys how I use my lines. Basically, I mark it out the same way, just that I'm only marking out the entry of the other block, where the other block starts from. So this is another block here. This is serving as liquidity towards this other block down here. This is another block down here. If you go to lower time frame, you see that this is an indecision week or something. So just understand when I say that candle wicks are other blocks too. If it's a candle wick on the 15 minute time frame, on the 1 minute time frame, that candle wick is another block. And now, when by candle wick, I don't mean by normal candle wicks by this now. Like for instance, this all these here, this, uh, And so this and so on and so forth. These are not other blocks. First of all, as I told you guys, criteria for other block, it needs to have cost, it needs to be originating from a swing discount zone that costs a break of structure. Remember, a break of structure. And then another block, I use wicks for other blocks on criteria. For instance, when the body of the candle wick is a huge ass body, as I said, this is a huge ass body. So you enter from the candle wick. This is a huge ass body. Enter from the candle wick. This happens all the time. I only use candle wicks and I get my better refined entries. You get what I'm saying? Let's go down to 15 minutes time. So I will explain to you guys what I mean. Self that candle wick is an OB on a lower time frame. So this here is one another one again. Uh let's get down to 5 minutes. Okay, we won't be able to get back there on 5 minutes, I doubt. Nah, we won't be able to get back down there, but it definitely is on the 5 minutes. We'll see more examples, so don't worry about that. Back to the 15 minutes. So I've only showed you guys here two of my entry models, which is liquidity entry model and SBR and RBS. I also use inverse key levels and key levels to enter, which gives me wonderful trades all the time as well. So I use like up to four, I use up to five entry models to trade. So that's why looking at my charts, if you're wondering what's this on, what's this on, that's why I just had to do this call to reveal it. Like when you see different entry models, because you think that this guy does not trade one thing, trades 20 things. Yes, I do because I understand what I'm doing. So now, as I said, this was here. I target the swings high because this broke structure. Remember that. So I did this. You can see went all the way. This was an inducement leg. This gave us an inducement leg on the higher time frame, and on the lower time frame, this is how the inducement leg looks like. This this is another OB on the lower time frame, but you don't just enter from this OB here. You don't just enter from this OB because there's no uh, engineered liquidity. There's nothing. You get what I'm saying? There's nothing. But in the case where there is an inducement like this now, this area where people will be buying from, you can see price even fake gave them fake hope. Look at what price did. Price came down all the way to this level here. Price came all the way down to this level here. Went up. Like I see, yes, trade on they go my way. Those guys now FOMO enter at this tip here. It could be like say their village people don't swear for them. They enter here. Okay, price is reacting from this OB that broke structure here. Let's go. Let's ride this thing. You know, FOMO. Click enter here. 0.101 lot size. That's how it's just reversed. They go think say now my this thing, na my village people. They will come go on X, see Dax or somebody, Sabi girl or somebody cut this move. Like how they'll be wondering how. This is the secret behind understanding sweet this entire thing. As I told you guys, what I'm teaching you guys here is premium and too premium to be free. Self, I'm teaching you guys how to understand market structure, the phases. You can see how we basically layered upon this section from this move here, we said okay, we did the analysis on the 4 hours. This was a swing here. We found out that this was another swing. So we predicted this. As you guys saw when I opened this chart, was this position already here? So I'll just be explaining all my positions to you guys. So that will make things faster. Safe positions I saw. There was no position here. I didn't take this trade then. I think this was when I started trading gold 2 months ago. So this was the entry. So I didn't see all these things. Yeah, I didn't take this trade then. I would have got some good money from here as well. So, and another thing is that liquidity helps you understand your targets. As I got in here, I would have sold all the way down here and I would have bought all the way. It will be like say they do magic, but trust me, this thing is very, very important. So, next is yeah, as we can see, we bought all the way up here, all the way up successfully. But at the same time, You can also be finding entries. All these day traders, obviously, this is like a kind of swing trade because we got in here at this trade triggered at 7 p.m., 8 p.m. that day, and it got TP at 7 p.m., 8 p.m. 2 days ago, Wednesday, and it got TP at Friday on midnight on the dot, or it actually got TP on Thursday, 11:45 p.m. So that is that. So now, next is, as I told you guys, first is first, you find break or structures on the chart. When you find break or structures, you mark out your premium and discount levels on that swing. This is a break or structure here. Rule 2 or step 2 I gave you guys, mark out your premium and discount levels on that swing. So from this entire region here, price can possibly reverse and continue buying. But we don't just enter anyhow, we wait for an entry model to form. So now we mark out all the OBs we can find on this level. This is a resistance level. So this could have been as an OB. As you see, market reacted here. Some would have gotten here, bought here now, and price have taken them out because they don't understand how the market works. Market works only with liquidity. So although they have bought from here, cover their low here and targeted here. Either way, they're profitable, really, really minimal. Just less than 2 hour. Very, very funny. So now we wait for the entry models to form. If no entry model forms, we are not taking this trade. Here, an engineered liquidity formed. This was an engineered liquidity here. As you can see, this happened directly above this OB. Are you guys seeing? This happened directly above this OB. It's not magic. And let me explain to you guys how it happened. On the 5 minutes time frame, you can see this is a day trade. This is a typical day trade. This is on the 15 minutes. This is a 15 minutes entry, this thing. 15 minutes swing. As you can see, 15 minutes swing. So now, just now, if it's a 15-minute swing, we're entering from the 15 minutes or lower time frames. So now, to understand what I said about engineered liquidity, this is an engineered liquidity. There's engineered liquidity. Engineered liquidity. Why is it an engineered liquidity, guys? Because it caused a break of structure. You can see this TP was taken out. If you understand all this TP was taken out. So this gave us a perfect engineered liquidity, which price did a fake reaction from as well. Are you seeing how the market works? Price did a fake reaction here. You can see price got all the way down here. It now went up here. You get what I'm saying? Before coming down, taking it out with aggression with one single 15 minute candle, then it began to buy ASAP. That is just one. Incoming. That's just one. So that's the first one. Let's look for more entry models. Break of structures happen everywhere, thereby OBs will be formed everywhere. It's left to spot whether there are liquidities. You can see all these are break of structures. Here, sorry, here, here, here. All these are break of structures. Now, are there OBs that are free? This OB has been mitigated. This one has been mitigated. This one has been mitigated as well. Sorry. This one has been mitigated as well. This OB has been mitigated. So all of these are mitigated. There is no imbalance in any of these OBs. This one here as well has been mitigated. This OB here before this break of structure has been mitigated. Before it broke this new high, has been mitigated. So all that, all that and that. Mm-hmm. So let me remove all those lines. So now let's get to the next this thing. Let's get to the next thing. So now, as I told you guys, I did not tell you guys my other entry models, but that's because these entry models they will make you too much money. So I'm just limiting how many things I'm showing you guys here on this free YouTube video. So the first things first, this is my other entry model, which I call inverse key level. Inverse key levels, whereby, oh jeez, should I be saying all this? But either way, it's not, nothing is bad in sharing knowledge and everything. So this is an inverse key level. Inverse key levels, the way they work, there is a, what they call it, a resistance level. Price takes out that resistance level and then invalidates the RBS, then comes back there and sells off from there. I don't know. Now I should explain this better, but let me just give you guys the hunch about it. So first things first, you need to understand how to spot an RBS successfully, because some people don't understand how to spot them. So basically, you have a resistance level. Let's say an RBS, an inverse key level. So basically, you have a supply level here, so a resistance level here. Price fails to respect that resistance level. Then price, after price fails to respect that resistance level, price will now come down instead of it to respect that resistance level as a support level and go higher. Price will now invalidate that support level for the second time again so invalidate that zone for the second time again, that row. It's now come back to that zone and tap it for a sell. So basically, this area, some people call it QM entries as well. Sometimes they go like this. It can come in two forms, like this. Now these things, you can see everything in trading is correlated. Some people call this head and shoulders. Some people call it different things. But head and shoulders is just a variation of, some people just, head and shoulders is just a variation of this inverse key level. This is another inverse key level, whereby you have this. The first one I drew out, basically I'm just redrawing it again. I'm just showing you guys that it's not only head and shoulders that is inverse key levels. So then you have this, then price comes back there and sells off. That exactly is what we call a textbook example of an inverse key level. So basically, there is a resistance level. Price fails to respect that. Price takes out that resistance level. It can be resistance or support, or support. Either ways it is. Price fails to respect that resistance level, breaks it. And price also fails to respect that. When it comes back down, it fails to respect this as a new support level. It then comes down, like down well enough to that level, giving it that, what do they call it again? Giving it that inverse key zone or level, and then it sells off from there. Yeah. So basically that's now. Doesn't need to sell off from exactly the line. It can come up to a supply zone here. So anything happens. So you just need to understand how it looks like. These are the two models, inverse key levels. I'm just explaining this because to explain why I took this position here. So this was an inverse key level. This was a major supply zone here. So it's like a major resistance zone, rather, or a supply zone, anything you want to call it. Markets fail to respect it. You can see the market crashed back down. And why did market fail to respect it? Remember, I told you guys there are supply zones everywhere. Look, this is a supply zone because this basically broke this structure. This did a breakup. BOS here. This inducement leg here serves as its BOS. You get, market broke it. This was a BOS. So you need to understand that this was a BOS. Market sold down here. So if this was a BOS, this was a supply zone here. You know what I'm saying? Then market failed to respect it. So okay, 4 ends in 15 minutes again. Let's round this up, guys. So So now this created this inverse key level here because this zone wasn't respected. And why was this zone not respected? Because there was no liquidity, no engineered liquidity, no inducement leg. Look, there was no inducement leg here. Markets failed to create an inducement leg here, and at the same time, there was no engineered liquidity. Market did not give any form of liquidity here, engineered liquidity. So as you can see, this is why that zone failed. There was no reason for it to sell off. There was no liquidity in that zone. That was a valid supply zone because look how market crashed. Yes, it had power, but it failed to be respected. So now the next thing you need to understand is this is another BOS. This zone here. So this is a BOS. So now as that is a BOS, what do we do now? We find supply zones in this area. And after we find supply zones in this area, what do we do again? We make sure that there is liquidity in that zone. As you can see, no inducement leg was formed. There was no inducement here. After this break of structure, there was no inducement that came here to do this for us to take it out and sell. So we don't just uh, mark an OB out and sell from the OB directly immediately. We wait for a liquidity to form. So I myself, I won't place my position 2 yet. I will wait. I'll mark out all the OBs. Now, another thing I need to explain to you guys is that the way I mark out my OBs, I'm dynamic in marking out my OBs. I don't just mark out my OBs in one direction. This is my OB. This also as well serves as my OB. This week, as I told you guys, this week serves as my OB. So now, if market has mitigated this, it doesn't mean this zone will not hold. It's over. It can still hold because there's still an untapped OB here, which is the week. As you can see, whenever I told you guys, whenever my market creates a huge ass candle or a long ass candle week, that week serves as the OB. So now this was the OB. Market mitigated this first one, but it won't be valid. Why won't it be valid? Because there was no liquidity in that zone. There was no engineered liquidity. So the market did this. So you can see this is a 15 minutes time frame trade, meaning that this trade will be quick that day. So markets broke this structure here to the downside, broke all these ones as well. All these ones that cause break of structures to the upside, broke all of them, creating this engineered liquidity all the way up here. You get that right? Creating this engineered liquidity all the way up here. You need to understand all this. It's easy, it's not hard in any way. Just need to learn how to spot them. Engineered liquidity here. So this high served as an engineered liquidity. Then I entered using the wick, covered the high simply, and then targeted my 5 hour here, all the way down here. So as I told you guys, that is that on how it works. Yeah, that's what I was saying again. This, for instance, now in this entire leg movement, this is another what do you call it? Zone that you need to understand. Okay, this is a premium or discount zone. So this is a swing. It caused a break of structure. It broke this high here. So this first swing broke caused another break of structure here. So we can expect that there will be another break of structure sometime in the future, which also happened here. As you can see, break of structure again. All these things are not random. You need to know how to read market structure. I'll probably make another video on market structure later on. First thing you need to understand is how the engineering liquidity concept works. So now this is another one here. This was a supply zone. It caused a break of structure to the downside here. Then waited. Was there any engineered liquidity or inducement leg? There was inducement leg here. So that served as a valid confirmation that okay, yes, this is a good trade. And this was actually a QMR. As you can see, it swept liquidity. And then that and that. So as I said, as I told you guys, uh, what do you call it again? I probably entered on the higher time frame or something because I'm not seeing any OB on the lower time frame. Everything here was mitigated. This here, this here, this here. So I probably entered on the higher time frame and down to TP 5 hour. Simple. So this was another OB down here because it caused a break of structure. But would I have taken the trade? No, because there was no this thing inducement leg. So I wait as price is coming down. If there's any engineered liquidity before the OB, I'll enter it, which was here. So it's an engineered liquidity. So engineered liquidity. Yeah. So you guys understand how all these things work, right? Engineered liquidity and so on and so forth. So this was the what they call it, RBS case or SBR case. Supports break of structure. It broke to the downside. Then we entered here at the 50% level, valid zone. Then we targeted down here. You get targeted down here, remembering that okay, this is what do you call it? Is this is a what's they call an entry zone? Oh, be careful. And then why did we enter from here directly on the higher time frame? This was a higher time frame trade. Why do we enter from here? Because on the higher time frame, we observed that there was an engineered liquidity, which was this here. This served as an engineered liquidity on the higher time frame. Now, although it's far up, but do you know why it still counts? Because of the way markets aggressively took it down and crashed immediately. As the market took it down now and still was doing zigzag, that wouldn't have counted. But because of the way market took it down immediately and crashed, we entered, said, okay, we can actually do this. Market is crashing in a straight line. Let us set our entry here. Let us set our limits. So we set our limits and then use the what they call it, the entries. People that use last bearish candle. This is what I said. Last bearish candle. Enter from here. Why did I enter from here? It's probably an entry from a higher time frame. Yeah, it's a higher time frame entry. Whoa. So we don't have much time. Let me just cap that. How many minutes left? Okay, so let's see more examples. Let's see more examples. Let's see more examples, please. So we find OBs, we find OBs everywhere. We find OBs, we find OBs, and then unmitigated supply and demand zones, which in this case was this one here. This is an OB here. This served as a liquidity here. So I enter this trade. This served as a liquidity here, and in this main leg, this here served as a liquidity. This low here. So we enter this trade, targeted the 5 hour because we're still targeting the top. Because this was a swing trade. Normally you should have targeted this top, but you get to some kind of point you tire, you exit the market. So I was just and I only targeted normal 5 hour rather than targeting all the way to this top here, which eventually still, you know. So let me take examples on other pairs as well to prove the universal working of the thing. So this is GBP JPY. This is the case of what do they call it? Of inducement entries. Let's go to the 1 hour. Yeah. So as you said, last bullish candle before an entry. Yeah. Last bullish candle before a downwards move. So we did that. Covered this high here, and targeted our normal 5 RR. Okay, I did six. No, 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 no. I shouldn't have done that. 5 RR normally. So that's what we do normally. So this is a break of structure. We find an engineered liquidity, or rather, this can serve as an inducement because this was still near it. This served as inducement. We entered it. The entry was a 4 hour OB. Let me show you guys 4 hours. So this was a 4 hour OB. Last bullish bearish candle before the upwards move. We targeted a normal 5 hour. Okay, so now this was the last entry I gave. This was the last signal I gave on Thursday to my guys. Let me show you guys the entry. Sorry. Let me show you guys the entry and why engineering liquidity matters very much. So this is a break of structure. Then the second step that I told you guys, After a break of structure, we mark out our premium and discount zones. So from anywhere in this zone, we'll be looking for buys and a valid reason to buy. So this is what we'll be doing. We mark out our premium and discount zones. Where's our premium and discount zone? Here. So anywhere from below here, market can possibly buy. So we only look for what they call it, valid reasons to buy from this zone. You get what I'm saying? So we look for liquidity and everything. On a typical day, nobody will be entering from here because this is not like a kind of leg, or let me say inducement leg. This is an OB here. As you can see, this is an OB here. This is another OB here. Sorry, so another OB here. This is where people would have been entering from, getting fat stop losses. There's another OB here. This is another one hit down here on 15 minutes, which was not visible on the 4 hours. So that's why we came down to 15 minutes. Now, if you observe one thing, anywhere from the 50% below, looking for entries. Now, we are taking it straight from here. Don't really know. This is a candle week. Could have used that, but eventually you would have gotten taken out. But that's not a problem because you would have still recovered your trade here. As you can see, there was no inducement, so we're looking for engineered liquidity, and that is what is here. As you can see, engineered liquidity before this OB here. So an engineered liquidity, because why is there an engineered liquidity? Because it broke this structure. As I saying, it broke this high here inversely. So as it broke this thing here, market came down and took it immediately, not with some zigzag movement, a straight movement. And then we, as this happened here, as at this point in time, 7:45, we already set our limit order because we've seen, okay, market is going up, but it surely come back down to tag us in. You get, because those guys will be like, okay, market is already going up the up direction. It's already buying from this OB. It has already triggered. It's already buying. Let us enter. FOMO. Enter here to just reverse as they enter. Noticing that they're village people, and then us that were smarter enough to wait, you know, we entered and then get our entry there and we go straight to TP and everything. So that is that. Let's look at an example on BTC quickly. How many minutes left? 2 minutes. Shit. So hope you guys have learned one or two things on these videos. So let me just explain something on BTC. This is a liquidity entry inducement. You can see this is an inducement, an area before this OB. I guess this OB was a 4-hour OB. I don't know. Yeah, this was a 4-hour OB. The last bearish candle, bullish candle before the downwards move. You can see how immediately price crashed here. I gave this signal. Uh, this crashed 5 hour. You can see I targeted the 5 hour. Then this is another one that we're looking to take now. I'm listening to you guys. As you can see, this is an engineered liquidity. I've already marked it out. This tip here, because it has caused a break of structure here, but that's not the reason why I'm taking this trade. The reason I'm taking this trade is because right from time I already knew that this trade, this sell will happen. This is a QMR. As you can see, this swept liquidity. This is our entry. This candle week here, you can see, and then this is an inducement here. This tip here, this sell, you can see some people have already started selling here. They're expecting price to go lower, but price will eventually come and take them out, tag us in, and it's a sell. This is the sell I gave for the signal of this week. This is the last thing I gave. So I hope you guys understand all this. It happens everywhere. Liquidity happens everywhere, even on the 4 hours. Let me show you guys the 4 hours quickly before this call ends. As you can see, this caused a break of structure. So we marked our OBs on this place. You can see all of this was an OB, but all of them were mitigated, but we did not enter. Why did we not enter? Because he did not give us any liquidity leg, he did not give us an inducement. So we're waiting for a structural engineered liquidity form. So this was engineered liquidity. This came here, took this out. So as you can see, this broke the structure, creating this low here, which is this engineered liquidity, which you entered from to buy here from this candle week here, which was also an OB, as I explained to you guys already. So we bought here, and all this is all how it works and everything. It's not magic. So hope you guys understand And class don't end already. Great class, great class. If you enjoyed this, please give it a like and drop a comment section on what you didn't understand from watching this video. Thank you very much. Yeah, have a nice day, guys.